These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will enter the reversing entry related to the accounts receivable adjusting entry into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We will first take a quick look at QuickBooks and then jump into Excel and enter our adjusting or reversing entry there. The accounts receivable reversing entry, like all reversing entries, will be done after the adjusting department and reverse the entry made for accounts receivable. Therefore, we need to know what that receivable reversing entry is. Remember, what happened is that we had an invoice that went out correctly, but the invoice went out after the cutoff date. In our case, it went out in March, even though the work was done in February, and therefore we needed to bring that revenue back into February. So we recorded the entry related to an invoice in February. And of course, what's going to happen there is that as of the point in time that the invoice was actually created, we have put that invoice in the system 2 times. In order to adjust for that, we could reverse our adjusting entry as of the first day of the following month. So first we'll take a quick look at QuickBooks and then we'll jump back into Excel. In QuickBooks, we have this information here, and we could do this once again, most likely would be doing this with the format of entering journal entries and make the adjusting and reversing entries. It is possible to do this with registers, however, and go into the use register and reverse the adjusting entry that was made. In essence, the adjusting entry was an entry that is behind the creation of an invoice. So what we're going to look at is we're going to say, hey, here's the journal entry for an invoice, and we will reverse that entry for our reversing entry as of the first day of the following month, in our case, that being March. So we're going to enter that into Excel, so we'll take a look at that now. Here we are in Excel. We're in our reversing entries tab. We're going to be entering a reversing entry for the accounts receivable. And in essence, what we're going to do first is take a look at this entry. This is a bit more complex of an entry when we're looking for the entry related to an invoice and then we want to reverse it. So the easiest way to do something like this, and this is similar to if we were doing a credit memorandum or something like that, is to look at the journal entry and then do the opposite. So we're going to go back to the adjusting entry and see what the adjusting entry was. So I'm going to go to the adjusting entry tab, and it's going to be down, I'm down here in A12 through D17. And the idea here was that as of the end of the month, the invoice related to this entry was entered, but not until after the cutoff date in March, but the work was done before the cutoff date sometime in February. The work in this case is the delivery of inventory. So we would check the shipping documents and we'd say, the work was done before the end of the month, and therefore the revenue under the revenue recognition principle, as well as the cost of goods sold under the matching principle, should be recorded in this financial statement. So this is just going to be the entry for an invoice. We debit accounts receivable, and then we credit the merchandise sales, the revenue, and then we have the sales tax payable, of course, as well, that we had to collect on it, is a credit. And then in the cost of goods sold, we had cost of goods sold of $400 and inventory $400. So what we're going to do is just reverse this. Again, it's going to look funny, it's going to look weird, and it's going to be actually not totally correct as of the first day of the next month. It won't be correct until the day we actually invoiced somebody sometime in March. So that's the cost we're going to have to sacrifice. We're going to make something look kind of funny until this next thing happens and that the invoice was issued. And once that happens, everything will be correct, and that'll give us a nice break between the accounting department and the adjusting department. So what we're going to do is we're going to debit the merchandise sales, we're going to debit the sales tax payable, and we're going to credit the accounts receivable. And then we'll do the debit to the inventory asset and credit cost of goods sold. Let's do that now. Back to the reversing tab. We're going to go all the way back over here to the right to the reversing tab. And we're going to do this as of the first day of the next month, as all reversing entries are the first day after the financial statements were created, which in this case is 3/1. And we're just going to reverse this out. So we're going to reverse the order a little bit too. We could make it just the same exact order, meaning before we debited the accounts receivable, and I could start with accounts receivable here, I won't do it, and put it as a credit, but then the credits would be on top and whatnot. And most of the time when you see these reversing entries, they still keep the debits on top, which means that we have to adjust the order a little bit. So what we're going to do is we could start with accounts receivable, but we have to make it a credit. So I'll copy that, and I'm going to put it on the bottom this time. So it's going to be down here in B8. Right click and paste 1, 2, 3, and we credited it for $525. It was a sales price of $500, and then $25 was the sales tax. So it's $525 on the credit. And then we had the other side usually is sales. If we were to think about it when we're creating the journal entry, sales usually goes up, and this time we're making it go down. Note that there's nothing in sales, of course, because it closed out already to the equity. So we're gonna make a negative sales here. So we're going to copy the sales. It usually goes up with a credit. We're going to make it go down with a debit. So we'll copy K22. We'll scroll upward B6, right click and paste 1, 2, 3. And that is for the 500, the sales price, not including the amount that we will be receiving for the sales tax. And then the difference, of course, is 25. And that's the sales tax that we're going to have. It's going to be also reversing. It usually would be increasing the sales tax payable here, and now it's going to be decreasing it. Note there is a sales tax payable here, unlike there was nothing in the sales down here, because this is a permanent account up here as opposed to a temporary account down there, and this account did not close out to, therefore, the equity account. So this is the credit balance. We're going to make it go down by doing the opposite thing to it, which in this case is a debit. So we'll copy K16, right click and copy. Scrolling up, we're going to put that in B7, right click and paste 1, 2, 3. We could indent this one over here. We can go ahead and increase the indentation, go into the Home tab, the Alignment group, and increase the indentation. Then we typically have, if we were to record this, we usually have the inventory going down, and now we're doing the opposite. So the inventory is actually going up with a debit because we're reversing this sales entry. So we'll copy the inventory asset, and we're going to put that in B10, right click and paste 1, 2, 3, and that was for 400. And then we're going to credit something, and the other side of that usually is cost of goods sold. Once again, cost of goods sold, like an expense account, it is an expense account, and it has a debit balance. It has a 0 because it's been closed out to the equity. It typically only goes up in the debit direction. We're making it go down by crediting it. So we'll copy the cost of goods sold, right click and copy, scroll back up, and that's going to go into B11, right click and paste 1, 2, 3. We'll indent that now, go into the Home tab, Alignment, increase indent, and there's our reversing entry. So this is usually pretty complex for people to kind of get the reversing entry by building it like that. It's easiest to think about, let's record the entry for a journal entry, debiting accounts receivable, crediting sales tax payable, debiting cost of goods sold, crediting inventory, and then reverse that. The thing that makes it a little bit more confusing is that we're going to have to jumble up the order in order to put the debits on top, the credits on the bottom. In practice, if you want to put the credits on top, just because it mirrors exactly what the other entry was, you can do that. It's not exactly wrong. It's just if you're getting picky about the format, we'll be picky about the formats. If your supervisor doesn't like the credits on the other side, then they will not like it. If you can justify it by saying that that makes more sense for the reader to be able to see what is happening, then that might be acceptable. A computer typically will always put the debits on top and the credits on the bottom, just because that's the rules of the system. Okay, so let's go ahead and post this. We're going to say here's the sales, merchandise sales. We're going to scroll down. Here's merchandise sales in M22. So we are in M22. We're going to say equals and point to that $500. You'll see that it goes up in the debit direction. It's actually kind of going a negative sales here, so it's making our net income actually go down. And this is unusual. It looks very strange. It should look very unusual. We'll talk a little bit more about why it is. We've already discussed it a bit, but we'll talk a bit more about why we're doing that after we record it. And then we've got the sales tax payable. Here's the sales tax payable here. Here's the sales tax payable here. We are in M16. We're going to select equals and point to that 25. Bring the bounce down from 125 down by 25 to 100. Then we have the accounts receivable. There's the accounts receivable. We'll scroll up. We want to be in M4. We are in M4, selecting equals, pointing to that 525, bringing the balance down from 11,274 by 525 to 10,749. We then going to record the other side. We've got the inventory asset, $400. So here is the inventory asset there. And we are in M5. We're going to select equals and point to that $400, bringing the balance up to 1713. Then we have the cost of goods sold. Scrolling down to cost of goods sold. Here's the cost of goods sold. We are in M25. We're going to select equals and point to the cost of goods sold, and that brings it up in the credit direction. Now, again, these income statement accounts, before we have any activity, before we've done anything in terms of sales or expenses or paid for anything or consumed anything, as of the first day of March, we've got these activity in here from the reversing entries. This, again, very unusual, and it's not perfect accrual accounting. However, it does help us out to make a systematic way to make these type of adjustments. Meaning, if there's an invoice that was sent out in March that should have been in February, we can have a system of our adjusting process to go through there and say, okay, we're going to look up for our shipping documents in March and see if there's any invoices that we need to pull back and actually record in February before we issue the financial statements. Then we'll do that. And then we can say, okay, instead of me deleting the original invoice, which could mess up our billing process and all that kind of thing because the invoice is tied to the receivable, then what we're going to, or instead of us trying to wait and enter the reversing entries as of the exact date and time, we will just reverse all reversing entries as of the first day of the next month. And that's going to result in this funny looking thing, reversed sales. But once the invoice is actually made, this will reverse back out to zero. And within the time period of that month of March, it'll be correct. Therefore, as of the end of March, when we make the financial statements again, this will be zeroed out to zero because this negative sales will match up against the actual sales of the invoice. And we had already recorded the sales in the proper time period in February with the use of reversing entries. So it'll match up and work itself out at the end of the day, and it'll also make it so we can have that separation between the accounting department and the adjusting process. Even if it's done by the same person, but oftentimes it's not, and we don't want our adjusting entries to mess up what's done on the typical day-to-day process. It's not good when the adjusting department makes their adjustments and then the normal accounting departments has questions about these funny things that popped up in there. So if we do these reversing entries, it will lessen those type of issues, those type of timing problems. Hello, in this presentation we will enter a reversing entry for the adjusting entry of accounts receivable within QuickBooks Pro 2018. If you've been continuing with us, we will be continuing with the Get Great Guitars problem. If not, that's okay. We're going to be talking about reversing and adjusting entry that was made at the end of the time period, the purpose of the adjusting entry, and the reasoning of the reversing process, as well as the function and how do we do the reversing process. If you have the backup file to this point, you can restore that by going to the File and Restore. We currently have the Open Windows tab open, which you can go to at View and Open Window List. The only open window being the Home tab at this time. If you want to open the Home tab, if it's not open at this point, go to the Company and Home page to open the Home tab. We're going to talk about a reversing entry for accounts receivable. And first, we have to look at why did we put that accounts receivable journal entry in there? What's the point of reversing it? And remember, we looked at this last time. We have a prior presentation of the adjusting entry for an invoice. The issue is that an invoice would have been entered after the cutoff date, and therefore the revenue would have been entered after the cutoff date for which the work was actually done before the cutoff date, and therefore the revenue that QuickBooks has generated for the invoice was posted after the date in which we need it to be posted in. In other words, in this case, it was posted in March. That's when the invoice was generated, and we needed to pull that income back into February in accordance with the revenue recognition principle. In order to do that, we reversed the whole invoice. We didn't want to change the invoice. We didn't want to change the dates on it because that's really not proper accounting. Oftentimes we can't do that. There might be other things that are connected to the invoice, and really we would like to have a paper trail in which the invoice is in there as its original format and make any adjustments that we need to at a later point. And so we made a reversing entry, basically making the journal entry related to a creation of an invoice into the adjusting process as of the end of the time period. Now we're going to reverse that. So let's take a look at what happened here. We're going to go to the reports up top. We're going to go to Company and Financial, and we're going to scroll down to the balance sheet standard. We're going to change the dates. We're going to go to Customize Reports up top, and the dates are going to be 01/01/212, 02/28/21, January 1st, 2021 to February 28th, 2021. And then we're going to scroll down to what happens with this invoice. So if we look at accounts receivable, we can see part of this transaction. And if we scroll down, we see that this is the invoice that we created. So this is not, it's actually not an invoice. Note that what we did is create a general journal that will mirror what would happen in the invoice actually having been created in the following month. So if we double click on this item, this is how we generated it. We didn't do a journal entry, we used a register in order to generate this invoice. If we close this back out, and if we go to the profit and loss by going to the reports up top, Company and Financial, profit and loss, changing the dates to 01/01/21 to 02/28/21. We're going to look at the merchandise sales, and we'll see this same information. So we'll double click on the merchandise sales, and there's that general journal again recording the revenue here in the sales item. So I'm going to close this back out. The other side of it is in the cost of goods sold here. Double clicking on that, here's the cost of that inventory, 400. If we double click on that, that's another registered journal entry that we put here. And closing this back out, we're back here. So in essence, when we create an invoice, we know that accounts receivable is going up. We know that sales is going up here. We know that cost of goods sold went up. And we know that inventory is going down and taxes payable is going up. So all that is happening when we created the invoice, and we adjusted that invoice back into this time period. Now let's take a look at the next month, the month of March. We're going to say that that is going to be 03/01/21 to 03/31/21. And so March 1st, 2021 to March 31st, 2021. We have this invoice here. This is the only thing we have so far, and this is the invoice that we entered in March that we had to then pull back to February, because at the point the invoice was generated was a point after the date in which the work was actually done, meaning the work was done in February and we wrote the invoice in March, QuickBooks recording the inventory or the revenue in March. So if we double click on this, here is the actual invoice that we basically recreated with general journal entries in February. And what happened when we did that then, we made February correct, but as of this point in time then, we're going to close this back out, close this back out. As of this point in time when this was recorded, now it's been recorded twice, meaning this $500 of revenue was recorded in February, the correct time period, and now it's recorded again in March. So what we need to do is have a reversing entry, and we're going to reverse what we did in order to put that journal entry into February. You'll note that this invoice was in there as of something like March 5th, I believe it was. The reversing entries, however, are not going to be reversed as of the date of this invoice that it's reversing. Typically, we're going to put them all in there as of the first day following the month that the adjusting entry was made. Adjusting entry made as of the end of February, a reversing entry then made the first day after, or March 1st. So there's going to be a couple days, in other words, between that point in time, March 1st, and the point in time that this invoice was created, where the financials are kind of wrong on an accrual basis, where that isn't reported. And that's okay because we made it correct as of the financial statement date, and then it's going to be correct as of the end of the month. It will be correct as of the date that this invoice was created. So we're going to reverse what we did in terms of an adjusting entry at the end of 12/31 as of March 1st of the following month. So let's do that. I'm going to change the dates back. I'm going to go to say back to 02. Let's make it go back to 01, 01, 21 to 02, 28, 21. Back to the prior time frame. Now there's two sides of this entry that we have to reverse. Typically, we would reverse these entries by doing a journal entry, by going to the company and going down to make journal entry. But in an attempt not to use debits and credits, we are using the registers in order to do this. So we're going to do this with registers, looking at plus and minuses rather than looking at debits and credits. It's going to be the same type of concept, however. So we have the sales. We know that part of the reversing process was that we had accounts receivable go up, we had sales go up, and the other side of that is the payable for the sales tax payable. If we go back to the balance sheet, that's actually the register it's easiest for us to use. Is going to be this sales tax payable account. We're going to go into the sales tax payable and basically record that half of the journal entry. So in order to do that, we're going to go to the banking up top. We're going to go to use register. And we're going to look for that sales tax payable. So if I scroll down, we're looking for the register of the sales tax payable. There it is. And we're going to say OK. We can now see what has happened before. So this is the actual invoice that we made this reversing entry for. So this entry happened in March. We made this adjusting entry, this general journal entry, as of the end of February in order to reverse this. And now we're reversing this entry right here. So this is going to be as of March 1st. And we're basically going to do the reverse of this item here. So if we look at this item, we see that we had a billed item, so we're going to be in the paid section. And then we have this split here. So if we want to see that split, sometimes QuickBooks will let us use the split icon and show us this split there. So there's the split. So we want to do the reverse of this, meaning we're going to go into the paid 25. We're going to go into merchandise sales, have a positive 500, and then accounts receivable have a negative 525. So let's close that back up. We're going to go into the paid section as of March 1st. We want to be on the paid side for 25. And then we're going to select the split. Instead of just one account, we need two accounts and see what that split will be. One account is going to be the sales account for merchandise sales. The amount of merchandise sales was 500. We're going to put a negative 500, which in essence is the opposite of what we did here because we're reversing this journal entry. The other side is going to be accounts receivable, and we're going to put a positive 525 in essence because that's reversing this transaction up here. It's the opposite of what we did here. And then we're going to choose the customer, which will be Sam the Guitar Man. We got to have a customer or QuickBooks will not let us post anything to the accounts receivable account. Now this is one of those areas where this ledger, putting it in this ledger is almost as difficult as, or it is surely more difficult if we understand debits and credits as using journal entries. However, if we don't understand debits and credits, we can use the register and possibly use a little bit of trial and error in order to work with the register. Typically, the registers work best when there's only 2 accounts involved in a transaction, and when that's the case, we can basically say we're going to do whatever we need to do to one side of the transaction and then just point to another account, and QuickBooks can, in essence, debit and credit the correct accounts. In this case, there's 3 accounts involved. That makes it a little bit more difficult. But we know what's happening in terms of, we know that sales is going up on our invoice, or sales is being affected on our invoice. We are reversing sales of the 500. We know that we're reversing the accounts receivable of 525, the sales plus the sales tax. And we know that the accounts payable is affected by the amount of, not the accounts payable, the sales tax payable, by the amount of the sales tax. So let's go ahead and see if it lets us record this. If we're not in balance, it wouldn't let us record this, and we can use some trial and error to try to figure out which way these things are going using the registers. So we're going to say record this. We needed to add a vendor here, so I added the vendor of New York State sales tax for that 25 and say record. There we have that information. If we go back up to the balance sheet now, we are going to look at the first date in March. So I'm going to change this to 03/31/21, first day in March, and we have the sales tax payable. If we double click on the sales tax payable, I'm going to change the from range to 01/01/21 and tab through this. We have our adjusting entry here. We have the reversing of the adjusting entry in the first day of the next month, and then we have recorded again, this being the actual invoice that was recorded, or in reverse, this is the original invoice that was recorded in the wrong date in March, which we pulled back to February in order to adjust for it, and then we reversed it in the following month so that these two will match out and not cause a problem. So we're going to close that back out. We should see the same kind of effect in the accounts receivable. If we scroll up, accounts receivable, double clicking on the accounts receivable, changing the beginning date to 01/01/21, refreshing this. Once again, we see our adjusting entry. We see it's being reversed as of the first day of the next month. And then we see the actual invoice, or in other words, the invoice was originally created in the wrong month. We recreated it in February. And then we reversed it the first day of the next month in order to cancel these two out and not have this entered 2 times. So we're going to close this back out again. We're going to go to the profit and loss. And if we take a look at the profit and loss, double clicking on the merchandising sales, we have this is the current period. So the period in which we made the financial statements as of, and we have the 500 in the New York State sales tax there. If we look at the next period, 03/31/21, then we can see the full items here. So here it is in terms of our adjusting entry. Here's us reversing it in March, and here's the actual invoice. So the same kind of pattern happening, or in other words, here it is recorded in the wrong month. Here it is us fixing it with an adjusting entry. Here's our reversal of that adjusting entry so that this is not entered 2 times. If we close that back out, now we're going to do the same thing for the second half of the transaction, that being the decrease or the increase in cost of goods sold, and the other side of that is the inventory going down. So if we double click on this item, we see this 400 right there. That's our adjusting entry. This is what we're going to reverse. I'm going to close this back out, and I'm going to go back into that register, or back into a register from the balance sheet, the other side of this being the inventory. So we're going to try going to the inventory register to reverse this. So in order to do that, we're going to go to the banking. We're going to go to use register, and we're going to scroll down to the register, the inventory asset register, clicking on that. And here are our items. So here is our adjusting entry as of the end of March or February. Here's the actual invoice, and here is us where we're going to just fix this. So we're going to reverse this back out. So this journal entry, it only has two accounts, so it should be easier this time than the last one. And note what we did here. We had the decrease side, So to reverse it, we're just going to go to the increase side here. And the other account here was cost of goods sold. We're going to have the same other account, cost of goods sold. So we're just reversing this item out. Then we will record this and see if it does what we hope it should do. So we will record this. Going to close this back out. And then if we go through our balance sheet, now if we look at our inventory, here's our inventory, double clicking on that. If we change the date range from 01/01/21 to the end of the month, here's our 3 items again. Here's our adjusting entry as of the end of the month. Here's our reversing of the adjusting entry as of the first day of the next month. And here's the actual invoice that was created in the incorrect month. If we close this out and go to the other side of this on the profit and loss, and we take a look at the cost of goods sold and change the dates from 01/01/21 to 03/31/21, we see that same activity here. Here's our journal entry, bringing it back into the month it needs to be in. Here's the error that happened, or the invoice that was created in the wrong month, and then here's us doing our reversing entry. In other words, here it is in the wrong month. It was entered in the wrong month. Right transaction, wrong month. Here's us pulling it back into the correct month. And then here's us reversing it as of the first day of the next month. So that would complete the reversing process for a invoice. And if you can understand this reversing process and this entry process, then you're doing a really good job of understanding what an invoice is actually doing in terms of recording the invoice. Because by understanding this process, you first have to know what the invoice is doing and know all the accounts that are affected in order for you to then enter the transaction to mimic what the invoice is doing without an actual invoice, but through journal entries and or through a register format, as we have done in the reversing entry process. And then you actually have to reverse that reversing entry, doing kind of the opposite of what an invoice does as of the next time period. So if you can kind of understand what's going on here, you're really going to get a good idea of what's going on when you record an invoice.